The S&P 500 index in the United States is set to lock in a fourth consecutive monthly gain today after U.S. consumer spending increased solidly in July, suggesting the U.S. economy remains firm. Our next guest expects strength in the tech sector to continue, but is cautious on consumer staples. Young-Yu Ma is Chief Investment Officer at BMO Wealth Management, and he joins us now. Young-Yu, thanks a lot for joining us. What is your take on this month we've seen in the markets? It began with investors very apprehensive about a possible rapid slowdown in the U.S. economy. Stock markets plunged, and then they just rallied all the way back.
Yeah, thanks, Paul. It's great to be here. Yes, we did have quite a start to the month and a reversal that was quite dramatic. We do think that that growth scare was very much overblown. We think that the underlying fundamentals of the U.S. economy and the markets remain healthy. Certainly, there could be a bit of soft patch or choppy data over the next couple of months, especially with the amount of election uncertainty that remains. But we do think that as we get toward the end of the year and into 2025 with rate cuts, with corporate spending, there's a lot that's coming into place in a favorable way.
You said in some recent commentary that there is substantial room to cut rates. How do you reconcile that view with what sounds like a fairly optimistic view on the state of the U.S. economy?
Well, inflation has just come down very significantly, and I think the Fed is realizing that, and we are seeing some weakness at the margins of the labor force. And Chair Powell, and I think the rest of the Fed as well, does not want to see economic momentum build to the downside or some of that labor force softness permeate more broadly. And given how high interest rates are right now, they're just very restrictive. And there's a lot of room to bring rates down, not just into the end of this year, but throughout 2025. But we think even with that, interest rates coming down, inflation is going to stay down, and growth can accelerate with low inflation in the current environment, not both this year and into 2025. So we think those two actually fit together, which paints a very healthy scenario for the economy and the markets.
Is there any potential here for equity markets to be disappointed at the pace of cuts from the U.S. Fed? I mean, the market became excited about the prospect of rate cuts way back in late October. And at that point, the S&P TSX Composite Index was trading at 4,100 points. Now we're at almost 5,600 points, and a cut has not been made yet. There's a strong anticipation of one coming in the middle of next month, but we still haven't seen cut number one.
Yeah, the markets have really just powered through, and the reason is the underlying fundamentals of the economy remain strong. Demand remains strong, spending remains strong, and inflation, even though we didn't get the cuts that the market was anticipating, or at least as early as the market was anticipating, inflation still did come down on a reasonable trajectory, other than a few bumpy months earlier in the year. So that was a healthy backdrop for the market. Could the market be disappointed? It could, but we think if that happens to be the case, if we get any signs of labor market weakness, the Fed is likely to accelerate its rate cutting campaign and probably pretty quickly reverse some of that disappointment that could creep in. So we're not overly concerned that disappointment would lead to downward momentum because the Fed just has so much latitude right here to cut rates over the next year.
Okay, in terms of equity markets, you and your team like U.S. infrastructure and the tech sector. Why so?
There's a lot of spending that's going to continue to flow into U.S. infrastructure. Some of that is government related, but also private sector related with onshoring, a lot of building up of the tech industry, the nuts and bolts of the economy continue to be strong. And of course, the grid build out, which is going to be very significant given AI demands and data center demands as well. So we think U.S. infrastructure continues to do well. And the tech sector, we think, is still in the early stages for AI spending. Right now, most of the spending is coming from the mega cap tech companies, a handful of mega cap tech companies. But what we think is going to happen in 2025 is that spending is going to spread out very broadly across the U.S. economy and among corporations that are really trying to ramp up some of their technology strengths and efficiencies, and that a lot of that spending is going to be directed toward AI, but the budgets are going to start increasing and new projects are going to start flowing once we get some of the near-term uncertainty behind us. So we're quite optimistic that that spending is really going to broaden into the next year.